Right then, let's get started. I think thanks everybody for being here. We're really excited this evening to share the secrets of tax efficiency for landlords with you. We're really hoping that you're going to learn a lot from this session. I'm Sarah, I'm part of the HMO Daddy team. And I just want to let you know about a couple of housekeeping items before we get started. First of all, we're running a hashtag. You'll be able to see on the screen in front of you now, hashtag HMO tax. This is for you guys to be tweeting as we're going through the event. If you've got any comments or ideas or anything you want to discuss, put it onto Twitter and you can use the hashtag HMO tax and we'll be able to pick that up and respond to your tweets. We've also got a few gifts for you through the event, just as a thank you for attending. The first is that we're going to give everybody a copy of the slides. All you need to do to get a copy of all the slides is actually take a photograph of your notes as you're scribbling down viciously with all your ideas and comments. Take a picture, post it on Facebook and tag Jim Haliburton, and I'll make sure that you get a copy of the slides sent over to you as soon as possible. Also, this is a live interactive event, so we really want to encourage you to get involved with the comments. We're running some live polls throughout the event, so as you see them pop up on your screen, please do select your answer and click submit. There'll be a few of those running through the event, and this helps us to tailor our content for you to make sure that you can get the best possible content out of the webinar. So let's get started. We've got with us Jim Haliburton from HMO Daddy and Simon Misiewicz from Optimised Property Accountants this evening. First of all, Jim Haliburton. He's got 25 years experience as a landlord. He's really seen it and done it all. He works with all different types of tenants, students, workers, unemployed and professional tenants. He's very hands-on in his business and he's very aware of how and why you need to be tax efficient as a landlord. And he's here to share some of his ideas and secrets with you today. Joining Jim is Simon. He became a chartered accountant in 2003 and he has been a property investor since 2006. He has purchased generally below market value properties and flipped them, and he is really walking the walk when it comes to tax efficiency. He's very proud to say that despite acquiring £1.5 million worth of assets, he's not actually paid any tax. So again, we really hope that you can learn a lot from Simon and Jim this evening, and hopefully you'll be able to go away and put these points into action in your own businesses. So I'm going to hand over to Simon now. Simon, you can take it away.
Good evening, and thank you very much, Sarah. And it's great to be part of Jim's team and Sarah. Sarah's done a fantastic job in terms of enabling us to be with you this evening. So thank you very much, Sarah, for that. A lot of what I'm going to be taking you through tonight is a number of tax initiatives that, first of all, you need to understand the implications of tax. And as Sarah has already said, we're going to go and hit you with polls. Now, I don't mean physically hit you, but I would like to kind of get your guidance. So we're going to kick off right now. And what I'm going to do is launch the first poll. And what I want you to do is straight away is answer the very first question. I promise you, they are not going to be very difficult questions tonight. I will save that for another day. But for now, I just want you to kind of answer this kind of question. Here we are. So what type of landlord are you? And all I want you to do in this one is just select one of those options. Now you could be a HMO owner with mixed tenants, single tenant types. You could be a single let landlord or a rent-to-rent landlord, or you could be doing any mixture of the above. So I pretty much wouldn't be a rent-to-rent, for instance, but I may well end up being a HMO with mixed tenancy types. That's pretty much where I would sit. So please feel free. I'm just going to give you a couple of seconds more. I don't think you need more than that to answer that very simple question. But as soon as you've done that, a couple more seconds, guys, then we'll wrap that question up. You can see how easy that is. So this is the hardest poll question I'm going to give you tonight. So hopefully you'll see how we work with you. Okay, I'm just going to close that one down. And why not share those? So let's see, let's see. I wasn't going to share them, but it may as well, since the information is there. So 42% are HMI single tenant types. No rent-to-renters. That's amazing. And some people that would do a mixture of all of the above. Okay, so thank you very much for sharing that, and we're going to potentially share this this stuff with you as well. I'm just going to take a screenshot of that. And the second one, I'm just going to quick question for you now is how many properties do you own? This is what you currently have, not what you want in the future. This is what you currently have, whether that is your own properties or indeed if this is properties that you own or have rents on. So again, if you don't mind, just select which one you fit into the category the most, and then we'll kick off. So I'm going to give you another 10 seconds, guys. 10 seconds, that's all I'm going to give you. High pressure here, it's almost like a boiler room of salespeople. So make sure that you kind of put your name, your number against the number of properties there. So I'll give you another 5 seconds. And we shall move on, and hopefully we'll give you some content at the same time. Great, thank you very much. So now I've just noticed my screen has gone off, so I thought it might do that. So I have to now do that. Here we are. So hopefully you can now see my slides again. So what I'm going to do is just ask you again to remember to type in HMO tax into Twitter. Let's let people know that you're on this event tonight. And indeed, let's stir some kind of activity within Twitter as well. So Sarah's going to be engaging with that. Now let's get into the real crux of things that's going on. And before I talk about the budget, we all know that there are different types of tax. So there's the income tax that you have on your property income. There's stamp duty when you buy properties. Your inheritance tax from your parents or your grandparents to you, and vice versa. You know, if you're going to be helping them with inheritance tax planning, then you have corporate tax. So if you have a limited company, the different types of taxes, and then CGT, and there's many others, by the way. So there's things like VAT that we've not even taken into account in here, which are all indirect taxes. That's quite confusing in itself. So one thing I would say with you is that you need to, in my view anyway, you need to simplify what you do. There's a lot of people that will try and complicate their business structures. Please keep it simple. There are so many people with limited companies, about 10 limited companies that I saw one client with before. Unbelievably crazy to have that number, especially when they weren't doing too much with any of them. So really, it's about keeping things nice and simple. And that's what I'm going to try and do with this webinar. So who is affected by the budget announcement? And that's a classic question, because I'm sure that you've seen the Facebook forums, you've seen the newspapers, you've seen everything go talking about the budget and how it's doom and gloom and how you should sell your properties. And I purposely got on the bandwagon of that to say it's the budget time, run for the hills. I was being flippant, because what I would always suggest is that you should look for opportunities as well as the downsides. It's too easy, guys, too easy to look at the negatives. It's the making of a better person, the making of a wealth generation business, to look at the opportunities, and that's what you should be looking throughout this presentation and everything that you see on the budget. So the key things, who does it really affect anyway, is high rate taxpayers, and I'll go into why high rate taxpayers are mostly affected. People with furnished properties, there has been a bit of a kick in the ghoulies, I should say, from that side of things. People that own limited companies and people with large asset portfolios. We're going to focus on the first three because that's all to do with HMOs, and I'm going to be really covering that off with you. So the question then is this, and I'm going to kick it off with the budget announcement question poll. So here we go. So are you worried about how the budget announcement will impact you? It's a simple yes or no. So if you're not bothered about the budget announcement, then that's fine. But if obviously you are concerned about it, then do type, but just press yes, because the budget needs to be understood. I'm just going to close that because that was quite a quick answer session, obviously. But I'm going to share with you the answers there. 80% of people are worried, and some people obviously not. I would say that you should be neither worried or passive. I think you should be looking at this and saying, what are the opportunities here? Which is something that Warren Buffett made his money on. What are the opportunities around this budget? And the people that are worried, I would say that you just need more information to make a better decision on everything that you're doing. So getting more information by listening to these type of events would be a good thing for you. I think I've got this sussed in terms of the PowerPoint presentation now, so I'm really good. So I'm going to lead now back to Sarah and Jim, and just for them to describe how the budget announcement will affect them without effective planning.
Hi, it's Jim Haliburton, also known as HMRC Daddy. Thanks for listening in tonight. It's a pleasure to talk to you. I was quite shocked by the whole budget. It came really out of the without any prior notification, especially for Conservative governments. But as Simon says, I've been around for too many years, some people might say, but certainly over 20 years, and I've seen lots of black clouds appear when it comes to property. And all these black clouds have turned out so far, luckily, to have silver linings. Yes, they have disadvantages, but on balance, the disadvantages are outweighed by the advantages. So you don't necessarily lose out on these things. However, this is, I think, going to be a game changer if it's implemented. Certainly for those who are going to be buying property and going forward, in as much as I can't see anyone who's going to be doing any kind of property investing over about 1 or 2 properties is going to have to form a limited company to get around the problems with the interest not being fully allowable. Companies that they will allow the interest fully allowable for tax, but not if you're an individual. It is a very, very strange move that the Chancellor's made. There's nothing like it in history that they've done this. You're in effect, as an individual, being taxed on income. It's also retrospective for people to set up their tax affairs. It's hitting them. So there might be light at the end of the tunnel. It might not be implemented, but it will certainly be implemented going forward. So those who've got a portfolio like myself are very concerned. Those who just starting up on the journey, you've got to now make a decision. It's probably going to be to form a limited company to buy your properties. It's going to have to be that way. So that's the big game changer. Before, you could just wander in and do it whichever way you wanted. Want a limited company, didn't want a limited company. Now it seems to being a big change. The implications are yet to be thought through, and I am certainly quite concerned about the change.
Thank you, Jim. And isn't it interesting, guys, that Jim has got so much experience, and I'm totally honoured to be on the same webinar as Jim. I've looked up to him for some time, and funny enough, I was sitting next to him on one of the graduate programs, and we started having conversations a bit like this in terms of the tax system overall. But Jim's got so much experience, and yet even Jim's making sure that he understands all the implications around tax. There's one thing to be a property investor, but then if you're giving all of your money over to HMRC, then does it really make it worthwhile? And one of the things that Jim and I will be talking about, not in this session, but in the future sessions, about why high rate taxpayers, or indeed people that are thinking about being a high rate taxpayer, are paying a lot more tax than they actually think they are. So it's just a really great insight for me to be listening to Jim and even listening to kind of Jim's concerns about how the budget announcement will affect us. So that kind of gives you a bit of an impetus in terms of the direction of travel for us tonight. Now, the thing I want to kind of go into, I'm just going to go to the mortgage interest tax relief. You can read this slide yourselves, but I'm going to just run through an example here. That Jane, in this example, is a high rate taxpayer, and the mortgage tax relief at the minute is always being taxed at whatever interest you have. You can offset all of that against your income, no problems at all. But from 2017 onwards, it's going to be incrementally reduced to that 20%. What does that really mean? This is where the confusion comes in, and this is where I want to just demystify that altogether. So from a perspective of a basic rate taxpayer, the mortgage interest relief does not affect you. Way, you're in luck. However, if you are going to be developing your property empire, you will be moving, you should be planning on moving, to being a high rate taxpayer. And as such, this could be a great example for you to understand. So Jane has got £12,000 worth of income on her property income. She's got £8,000 mortgage interest, £4,000 on a repair cost, and £1,000 property management fees. And you can see on the bottom there, she's got £1,500 loss per year. And if it's a repayment mortgage, which is capital, bear in mind, she would actually be losing more in cash. But in this situation, you can see that Jane is actually losing money on her property income as a high rate taxpayer. Why should that be of interest or even of concern? Well, this is the reason. Let's imagine now, the previous slide, I've shown that she had £1,500 loss per year. The problem is because the mortgage interest that she had was £8,000, she's now halving that interest. So the government are saying, that's great, you had £8,000 mortgage interest tax, £8,000 mortgage interest to offset against your income. So the £4,000 add back, so this is where she had £8,000 of mortgage interest to offset against her income. Now it's only £4,000. So she's having to add back that £4,000 that ordinarily she would have put against her income. So now she's got £2,500 taxable profit, which is going to be taxed at 40%. So she's going to be paying £1,000 in tax despite making a loss of £1,500. So you could be technically making a loss on your property portfolio as a high rate taxpayer, but you still pay tax on it. And I'm sure Jim would agree. That is ridiculous. But it is the way that George is going to implement it. I think as much as we want to try and fight it or attack it, it's going to come in one shape or another. So it will affect us all if you're a high rate taxpayer. Now, you may be sitting there thinking, but Simon's just said, if I'm a basic rate taxpayer, then this won't affect me. If you are close, let's say that you've got total income of £35,000 and this mortgage interest relief gets added back to your profits, it could all of a sudden move you from being a basic rate taxpayer to being a high rate taxpayer. Now, does that affect you? I'm sure there'll be people out there that will be kind of nearing that high rate tax bracket, all of a sudden starting to sweat. So that is, in effect, the mortgage interest relief in simple terms. You will see all sorts of explanations and equations. I would say ignore that. So just to summarize, the fact that she's got £1,000 that she's had to pay out because of the loss that she's made, she's got £1,500 tax to pay even though she's made a loss. Now she's got £2,500 cost of holding that property. So she's not actually generating any cash. She's paying £2,500 to look after that property. Now we all think that properties, there will be a capital growth. I'm sure there will be, but we've got to be mindful of, well, if that doesn't happen, people could start losing cash by holding properties. And that is not a good place to be by any means. So what I'm going to do, because we said we was going to make this interactive as much as possible. So if you've got any questions, then please feel free to put that. You've got a question box, I'm sure. So my question to you right now, and I won't share this results, no one else will see this, but are you a high rate taxpayer? And therefore, by you saying yes or no, we know to tailor our presentation to you. But if you're a high rate taxpayer, guys, this is going to affect you, and whatever structure you have going forward needs to mitigate the mortgage interest tax relief. At least there are some other issues that you're going to have, but that is the biggest one that you all need to consider. So what, like I say, I was going to just go through through the question set. Now we've got a couple of questions. I'm not going to be able to go through all the questions. Everyone's voted by looks of things, so I'm going to close it down. You'll see that there are 63% on this webinar tonight that are high rate taxpayers, and 20%, 30% that are not. Only 66% voted, by the way. So guys, come on, this is your webinar. This is not mine. It's not Jim's. It's not Sarah's. It's your webinar. So as much as you get active in this, don't be passive in life. Make sure you take action in everything that you're doing. The people that are passive get mowed down, in my view. So please, next time, get onto this webinar, these votings, and get your voice heard, get your opinions heard. So let's have a look at the questions that we have on here. So let's see if it's on there. Do asset trusts help? Could this help? We're going to stay on tab, really, because it's more about what happens with the budget and how it can affect you. There's loads of solutions that we're going to be talking about, but it's an hour, you know. So I haven't got 4 hours to go on this, so I will be staying on cue. Otherwise, Sarah will quite rightly kick me, and I don't want that to happen tonight. Okay, so let's just carry on with the slides of where we are. So thank you very much for the questions. There weren't that many questions, but please feel free to ask them as we go along. So the next step. 10% wear and tear. Now this is an interesting one. So if you have furnished properties, like HMOs typically will do, but you could also have furnished properties like singlets, don't forget, the 10% wear and tear. So this is whereby you could claim 10% of your net rent. So if a property that is a HMO, £2,000 worth of rent in a month, and the tenants paid their utilities, just keep this nice and easy, then if you furnish that property with beds, cupboards, fridges, freezers, carpets, curtains, TVs, and so on and so on and so on. I'm not going to bore you to death with all the things you can do, and you can see the list there. But you could claim 10% wear and tear. So 14-15, you could claim wear and tear. Going forward, though, the 16-17 tax year end, that will be abolished. There will be no 10% wear and tear. That is a major issue for not just high rate taxpayers now, but for basic rate taxpayers as well. So if you've got furnished properties, this is something, again, that you need to look to mitigate. So I'm not sure how many people got furnished properties, but it can be a serious concern for you. I established that looking through, we looked about maybe a sample of 100 clients of who this really affects. And sure enough, it was 20% additional tax as a result of this one change from the HMRC. So you can see already the impact is significant. So whereby you've got your 10% wear and tear, that is now being removed from 2016. I'll give you an example of that right now. So again, the assumption here is 12,500 rental income. You'll see your mortgage interest, which it looks quite high, I've got to be honest, but as an example, hey guys, property management fees, then you've got repair costs. So it leaves you with £800 worth of profit. You'll notice that that's 10% wear and tear is of the 12,500. So we've just tried to make it a nice, easy number to understand. So you might make £800 profit, but because you had 10% wear and tear, because you furnish your properties, you then made a loss of £450. That meant that there was no tax. Hold on a moment. So what does this really mean for you right now? Well, the 10% is gone. So you will still make that £800 worth of profit, and you will have this £320 tax as a consequence. All of a sudden, you didn't pay tax, now you are. So this is a major concern that you should be having and maybe planning some solutions. Tonight is really making you aware of everything that will affect you by this budget announcement. But equally, don't be depressed and taking Prozac and whatever else. I would suggest that you start looking at this and thinking, what are the opportunities here? Because there'll be a lot of high rate taxpayers that will be chucking in their properties, and we'll talk about that later on. So what if you're a high rate taxpayer and you've got a HMO? Well, before you've got 12,500 rental income, you've only got 50% of the mortgage interest tax relief. So now you've got only 4,000 to offset against your income, 1,500 property management fees, and 2,200 repair costs. Now you're making 4,800 profit, whereby before you was making a loss. Now you're making 4,800 profit, tax at 40%, gives you a tax liability of £1,920. One property in 1 year. That's a lot of tax to pay on just one property. So if you've got 10 properties, you're talking about £20,000 worth of tax, just because the 10% wear and tear removal and the interest relief being halved. That's significant, no matter who you are. And that's something that you need to work out how you're going to mitigate it. And trust me, you will if you work on the right strategy. So overall then, before the budget announcement, you've got no tax to pay. That's good. But now you've got £320 because of this wear and tear removal, and £1,600 because of the interest tax relief cap. £1,920 additional tax that you didn't have to pay for, bearing in mind that you was making a loss of £480 on that property. So in effect, you're near now to giving out to either HMRC or to pay for making a loss on a property, nearly £2,500. That is significant, and that is whereby, no matter what capital growth you can expect, this would hurt, no matter what your situation is. A couple of suggestions that you might want to consider, though, is whereby you have properties whereby you're buying them in the future. So if you're going in to buy a property and it's already kind of furnished, whereby it's got curtains and it's got some sofas, and you're buying it from a couple that just want to leave everything there, your negotiation point with them is leave your furniture and we'll give you some money for it. The reason for it is that there are significant ways of going to that property and say, well, actually, I've got a list from my solicitor to say and prove that this property was furnished. Now, why is that so significant? The significance is that if you've got furniture that you are replacing, then you would be allowed 100% of that cost. So every property has got carpets, but not everyone really specifies that on their itinerary list. So I would suggest that you make sure that when you're buying properties, that it does state that it had carpets, it had curtains, and if it had a sofa, great. You might decide to get rid of all that. But the fact that you've suggested and you've got proof that you had it in the first place, then when you do buy new curtains, new carpets, and bedding and whatever else, then all of a sudden you can put that cost 100% against your property income. Now, for my money, that's much better than the 10% wear and tear. But obviously, that's for new properties that you're buying in the future, not your existing ones. So the replace, repair, renew, which is hopefully something that Optimizer are coming infamous for, it will work for the wear and tear allowance as well. So it's a great way of when you're looking to buy properties, again, remember, what are the opportunities? Stop looking at what the negatives are. This is a great opportunity to buy properties and say to the person, look, I'll buy your furniture off you for £500, and then you replace it with all new good stuff, and you can offset that against your tax. There are other benefits of having furnished properties, and I'm not really the best expert in this field. I think it's more to do with Jim. So I'm going to hand over to the legend himself. Jim, what are your thoughts?
Hi, yeah. It's a bit of a contentious issue whether you should be furnishing your properties or not. I've never really given it a second thought. All my properties are furnished and generally have central heating included as well, because I'm aiming at the working market or the professional end, or even the student end of the market, who expect that. And this is the important thing. It's what your tenants want, not so much as what you want. You're in a competitive market. It's getting more competitive. More people are entering into the business and providing amazingly good quality of accommodation. However, there are areas of the market where furniture isn't so important. If you are letting to the unemployed, it's not generally known that the unemployed, though they are down on their luck often, do get a lot of assistance. And one of the assistances they get in most areas is access to free furniture. You have what's called furniture banks. People have heard about food banks, and it's considered outrageous that people are having to rely on free food. But for the unemployed, they do have other benefits like getting free furniture, free clothes, sometimes even free holidays. And we all know they get free legal advice if they want to sue the landlords, but we won't go off about that one. Anyway, going back to the point about the unemployed, is it's sometimes best not to let it furnished, because the more they put into it, the more they're going to make it home. So for that small end of the market, and most landlords I come across don't deal with unemployed, you really are looking at providing the properties furnished. And it's what Simon says is great. I'm just wondering, Simon, if you follow the idea that you get hold of some old furniture and then replace that. So you are technically renewing it. So go down to the second-hand shop or even have a look at a few skips, put the furniture in the house, and then technically you're replacing it when you buy other furniture. Is that an idea, Simon?
It is. I've seen the issue with that kind of thing is that it can be easily frowned upon by HMRC. So there's a great author, or I shan't mention because it would be taken the wrong way, but to be fair, a great author, a great tax expert, and hopefully a good friend of mine as well. But he wrote about putting soft furnishings in a property that was inflatables in a property, and I can see the merits of doing that, as I could see it from a side of things of having second-hand furniture than buying new. I think my issue with that would be HMRC's perspective is it's been done purposely just to utilize this new tax change. So yes, there are those things that it sounds like a great idea, but we've always got to be mindful of case law and how HMRC see it. But you never know. Again, it's always looking at the opportunities and then just making sure it has got strong merit.
No, I agree with you. You've got to be very careful about what you do.
But I think Jim and I will share with you some better kind of things that you may see on the forums in terms of how to mitigate a lot of these taxes. So that's something to bear in mind. That Jim has got some fantastic experience, and I'm pulling on that to give you kind of the taxation side of things as well. So you can be effective at buying properties. I'll just make you efficient as well from a tax side of things. So questions. So if you've got any questions, now is a good time to do that. I have got another poll, and I'm going to launch over. It's one of my last two I'm going to be doing tonight. So I guess the question, I was going to do this later, but I'll do it now, is one of the suggestions is, do you run a business as a limited company? It'll be interesting to see what the verdict is. I was going to run the content and then kind of give you this. I've just seen a question, actually, funny. So Jerry is wrote out saying, forming a limited company is fine, but you pay 20% corporation tax and 27% on dividends equals 47% tax, which is worse. You're absolutely right. You need to be careful of how you pull money out of a limited company. So if you look at it as plain sight of day, yes, you could be in an issue whereby you pay 20% corporation tax and then 27% additional tax on dividends if you're a high rate taxpayer. But there's so many other ways of taking money out of a limited company, and therefore knowing what you know right now won't give you any advantage. But there's a great saying, there are things that you don't know what you don't know. And that one I've heard so many times, and I use it quite a lot for myself and my own business, is I don't always know what I don't know. I don't even know what questions to ask. And that is why we're going to come up with some ingenious tax strategies of using limited companies and other mechanisms to make you tax efficient. But interesting enough, I'm just going to share the results of that. 74% don't use limited companies, and yet if I remember the poll, over 60% were actually high rate taxpayers. So there's an interesting split there, that there's probably a lot of people out there overpaying on their tax more than they need to. So that's I'm quite upset for you guys, because you probably be paying more tax than I've ever paid tax before. And that's something I'd love to resolve with you. So we'll be challenging myself and my capabilities on how to do that. Is there analysis done on what effect will be from the new legislation on landlords with 75% loan to value, 70% and different mixes of loan to values? Is the effect greater, getting less or worse? I think if you've got a level of mortgage whereby you've got, I think there's two sides to this. If you're highly geared, then you will be paying more interest, therefore your cash flow is not so great. But equally, if you are highly geared and you had this mortgage interest relief to reduce your profits, now you're going to get hammered twice, because you've got this high amount of gearing, and now you're going to be penalised for the mortgage interest that you've been offsetting against your income. So I think it's going to get worse, if I'm honest. I'm not saying, by the way, that the solution is to stop paying off your mortgages. There are different, and this is why I'm saying to Jerry, your circumstances will dictate what the solution should be. And it's not just you, it's your family members as well. So one thing I would start saying is start working with experts that you know, and hopefully Jim and I will come up with some ideas for you too. So one of the things that if you're not aware of this, which is what Jerry was saying, you pay 20% corporation tax. Well, actually, that's going to be reduced to 18% by 2020. And don't forget, let's imagine that you had a company that was generating £200,000 worth of profit in a limited company. You may not need to take all of that £200,000 out. So the 20% tax that Jerry mentioned, and then the 27% on dividends. Well, you don't need to take all that money out, so why not leave it in the company? And I'll talk to you a little bit later on about how you do that. But the corporation tax level will be reduced from 20% to 18%, and I'm already rubbing my hands with glee about that. So I'm going to be making an extra 2% on all of my flips and all of my business activities. I'm overjoyed with the budget announcement, I have to say. But then I'm always overjoyed because I'm always looking at the opportunities. So what does that really mean? Well, people with limited companies, if you had £100,000 profit, listen, you're all intelligent people on this webinar, you can see for yourself what the impact will be. And if you compound that over time, then the amount of tax savings you will get, it will be significant. And bearing in mind, the reason why I'm bringing this to your attention is by 2020, when it is 18%, is actually less than basic rate taxpayers themselves, because basic rate taxpayers pay 20% on their self-assessment. As a company, it's 18%. So go figure. The government have switched this whole thing around and said, anyone with limited companies, you will be better off. Okay, so just start to think about that. How can you benefit from using a limited company? There are some issues, again, this is an hour's webinar. I'm not going to be here talking all through the night and talking about the maximum detail. But some of the things you might need to look at is there will be tax on dividends for basic rate taxpayers. There's 7.5% if you take over £5,000. So there will be additional tax on those dividends. However, look at the opportunities. You can keep money in the limited company, which then can reinvest in more properties. The company can buy its own properties if it wants, so they can either keep the money in the limited company as a nest egg, or it can start to invest in properties or other sorts of investments itself. You can invest it in a pension, and don't forget that pensions give a nice tax relief. Equally, so do EIS. So the limited company and you as an individual could invest in pensions and EIS. And that is something that, as optimized accountants, we're getting an awful lot more interest in pensions, especially when you can use that pension to invest in residential properties. You've heard it right. You can use pensions to invest in residential properties. It's a myth that you can only use pension money in commercial properties. And again, that is something that Jim and I want to introduce to you. I'm going to just have a look at the questions that you have set out so far. And just type in if you're finding this information useful as well. If you're finding are you learning anything new? What are the things that you've picked up? What are the opportunities? I don't want to hear the so much the worries and the pains, and everyone can talk about that. But what are you finding this interesting? Are you getting a lot out of this information to be a bit more aware of the budget announcement? And indeed, what have you picked up as an opportunity? Coys has said, I'm just starting off. I'm a basic rec taxpayer. I'll be starting to look at start a HMO strategy. Well, Jim is clearly your man for that. Buying on a normal repayment mortgage, then refinancing on a commercial remortgage. How will the budget affect me? That's a great question, guys. If you're a basic rec taxpayer, I don't really foresee it affecting you at all. Where it will affect you is when you move and you develop your property empire, and then you move into being a high rec taxpayer. Equally, don't forget, we've already spoke about the 10% wear and tear removal. But the fact that you're starting out, the fact that you're starting on your property journey, you should be listening to what I said earlier, where I said, make sure that the properties are already part furnished and then replace those items. Make sure that you get your solicitors to do their job, because they won't if you don't push them to itemize everything that's in that property. So actually, guys, you're in a better place than most. Okay. That's the questions done. Okay, let's move on. So I'm going to hand over now to Sarah. So Sarah, are you there?
Yeah, I am indeed. Wow, that was very interesting. Even for me, every time I listen to you guys talk, I learn something new. 1 hour just isn't enough time, is it, to get through all of this information? So I talked earlier about a couple of gifts we were going to give to you guys for attending. The next one is actually we're inviting you along to a half-day workshop in Birmingham. You can choose either a Friday morning or a Saturday morning. Some of you may still be employed and not working for yourselves, and so Saturday morning may be better. We're actually going to run 2 half days, and you can attend either of those. We're doing it in Birmingham. I can give you the address in a short while. It's actually about 5 minutes walk from New Street Station, so really accessible for you guys. I know we've got the geography map of people booking on. We have people from Scotland right down to people from Cornwall, so I know there's a big mix. The half-day workshops are going to be putting meat on the bones of what Simon and Jim have talked about this evening. So giving answers to those questions around things like asset trusts and how you get your solicitors to actually itemise the items in your house during the process of purchase. So the half-day learning is going to be delivered by Simon and Jim. There is going to be breakfast included, so we're running a mini networking event at the beginning of the day over breakfast. Your opportunity to potentially link up with some JV partners, pick the brains of the experts in a more casual fashion, and then there'll be some intensive training on the tax efficiency for landlords topic. We are providing this half-day workshop for you. The training's actually free of charge. All we're doing is asking you to help cover the costs of things like breakfast and the venue hire and so on. To talk you through the benefits of attending, there are many, and as you've already kind of heard from the webinar, 1 hour just isn't enough time. So this is going to actually really fill your minds with some of the solutions of how you get around some of these key issues. What are the opportunities? Simon said it quite a few times. It's not all doom and gloom. So come and learn about what the opportunities are to be able to implement the strategies and the tools that these guys are using to be tax efficient, to make sure that you can save thousands of pounds immediately. You'll be ready for the mortgage interest relief changes in 16 and 17, and it's just going to be a fantastic morning. We're also offering another little gift for the first 20 people that actually book onto the half-day workshop. We're going to send you the digital download version of Jim Haliburton's 35 money-saving tips for HMO landlords. Now, this is a fantastic read. It's a really simple read, but it's got 35 tips of how you can make more profit from your business, how you can squeeze every single penny out of your HMOs. So for the first 20 people that book on, we're going to give you that free of charge as well. Half-day workshops, just £87, and that's all inclusive for breakfast, the networking before and after the event, and more importantly, the actual training being delivered by Simon and Jim. All you need to do to get booked onto that is to open a new email in your inbox, send an email to sarahp@hmodaddy.com. If you include the preferred date, so either the Friday morning or the Saturday morning, which is the 5th or the 6th of February 2016, include your phone number in there and I will give you a call and we will get you booked on. There's obviously limited spaces because the venues have only got so many seats, so do get that email to me as soon as you possibly can so we can get you secured. And like I say, the first 20 emails that arrive, you'll get that free digital book dropped into your email box tomorrow. And that's it from me. We look forward to seeing you on the half-day workshop.
Absolutely. Thank you, Sarah, for that rundown. I think in terms of the price of £87 for a half-day workshop, in terms of where you can literally save thousands, you're not going to be going onto one of these forums whereby they talk about property strategies. It's going to take you £10,000 to invest into it, not just the course, but also £10,000 for the investment. These are the things that you can do immediately. So as soon as you leave that forum, the idea and the concept behind everything I do is to give you ideas and concepts that you can implement straight away. So for a case of £87, guys, you need to be taking action on that. And like Sarah was saying, you do meet other people on that network environment, and there's so many joint venture deals that go off on my courses alone. I'm sure that happens with Jim as well. So do get yourself onto that. But thank you very much for your time, for being with us. And what's great tonight is everyone stayed to listen for it. So thank you very much for your time. And thanks again for the legendary Jim. You know, I'll always be highly respectful to you. But also, thank you ever so much, Sarah, for putting this show together and getting us finally to do something together.
It's been a pleasure. Thank you very much. I think Jim's just got a couple of things he wants to say.
Yeah, sure. Simon, I'm flattered by you think I'm a legend, but yeah, it's been a pleasure. You make it, as always, very interesting to hear you talk and make tax so simple for people. And if you come along on the half-day workshop, it'll become much clearer. You'll be able to understand your options and also pick up quite a few tips, not only on tax, but other aspects of the business, especially if you're looking to do HMOs. I'll be coming along and I'll be glad to talk to you all. It gives me great pleasure to meet other investors and talk about the business. Thank you very much for listening. Hope to see you soon.
Good evening, guys. Good night.